Okay, well, what you're seeing is absolutely unrelated. This is one of my trades. I'm going to try and put the chat window somewhere. Oh, okay. So let's move to PowerPoint. So I don't know whether you have had a look at the previous sessions. As I've said several times, this is not a training course. So I go and visit topics as I fancy, or depending on the time I can allocate to preparing this presentation. Last time it was actually quite interesting to go into the SKU, but I think it requires a bit more preparation, and I'd like to use my own software for that purpose, because there are things that are not available in on existing platforms. So anyway, so today I was a bit short of time, so I'm going to talk. Let me see. I can do. Okay. Today I'm not going to talk about weighted VEGA and SKU. I think I need to prepare 2 or 3 sessions specifically on that. It's actually an advanced topic. I also realized that I made a small mistake last week or 2 weeks ago. It's either divided by the square root of dt over base dt, or multiplied by square root of base dt over dt. So basically, when we use 30 dt as the reference, the time-weighted VEGA is usually lower for longer dated expiries, because this ratio is below 1, and it may have another effect of actually increasing VEGA. And the jury is still out on whether it is of any interest for short-dated expiration. So I will give it a try. Again, I mean, it requires a bit more work. Okay, so, and also I have realized that what was shown in 2015, 2016, introduced by Ron Bertino using a reference from a book from Nassim Taleb, it looked like it was, if not contextual or circumstantial, it looked like his formula works better in times of contango, or even sharp contango. So I think it's actually more complicated. So this formula is probably not so good. In other words, when the volatility term structure flattens or goes into backwardation, I think we get closer. I mean, time-weighted VEGA goes back to the VEGA given by Blackett-Scholes. Okay, my software is, I'm busy simplifying a lot of the code for pre-release end of the month, so I can't really show. Basically, it's not running right now, but this is something I plotted, I think, last week to show. It was a September-October calendar, 3000 calendar, and indeed it shows that the time-weighted VEGA, I mean, accentuates the variations of VEGA, and you would anticipate that you would get maximum VEGA near the strike, and it seems not. So it's actually, again, I'm going to revisit this now that I've got it in my software. I will visualize and really look at really what it does. I mean, a lot of people just do back of the envelope type of Excel calculations, and as I said, it's not available in other software. So now that it's there, I will have to study this a bit more. Okay, so today I want to go back to a little bit of math, not complicated. So we go back 2 sessions where I talked about put call parity. It is something that is quite valuable and quite interesting to use for European options. Some people use it also for American options, knowing that it is not 100% correct. And that's going to be another topic, because it's not only it's a bit more complicated, but when it doesn't really work, we have to figure out what to do. Technically, American options should not be exercised most of the time. So the price is slightly different, but the chances of being exercised or exercising an option are actually generally not there. So that's why some people also use that for American options. But let's stick to what it was designed for. So this is the put call parity equation. And as I said last time, for if we want to assume that the interest rate or the time to maturity is negligible, a lot of people use this. So basically, call minus put should be equal to the underlying minus the strike. So that's basically what most people use there. Now, something that I've actually coded in my software, and it's quite interesting, is that because of this factor, it is actually a relation involving the forward price or futures price. But the futures price is generally not available. So that's why we use a synthetic forward instead. I will get back to that right now. So what is interesting is that put call parity is independent on modeling. It is essentially a no arbitrage necessary assumption, but it's not. It is something that is valid even if you use something else, like the binomial model. It's also there. Or binomial is also called sometimes the Cox-Rubinstein modeling, binomial, trinomial. There are other ways of pricing options. It's actually more interesting in a training course because it's sometimes the binomial model is sometimes more visual, but in terms of computation, it's more complicated. And the Greeks are, well, maybe easier to understand, but it's actually very, very computing intensive. So if we go back to put call parity, a put is equal to a call plus the strike. So basically, I just move some elements around. It shows that basically you can build a synthetic put from a call. So those things. This is where it is quite important. And sometimes, if you want to manage your cash flow, your margin, it's sometimes better to be long call than short put, for example. So, and it shows that basically you can rebalance your position for other reasons than the Greeks, just for cash flow or margin consequences. Another thing is that there shouldn't be any arbitrage opportunity. It should be exactly priced the same, but it all depends on liquidity. And I don't know which type of strategy you trade, but sometimes, for example, I could show you some of my trades. When the market drops and you do not roll back because you have other adjustments at your disposal, your upper long puts can be deep in the money, and you will see that the spread gets wider, and getting rid of those upside legs can be more difficult. So that's another reason sometimes for moving on the call side. The issue of dividends. in Black and Scholes and in this put call parity, the easiest thing is to assume a continuously distributed dividend. So you actually turn in any equation the strike into S multiplied by the exponential of minus QT, Q being the dividend. So generally, even if it's not always 100% valid, that's what most people do. And sometimes it's actually even simpler. People just remove the value of the dividend from the strike price. So this is something I just wanted to show. It can also be put into the Black and Scholes equation, and if we go back a few sessions where I briefly introduced also Bergson-Stensland, which is the modeling that is used by default on TOS. It's actually just a small variation on Black and Scholes. Really, it's the same basis, the same hypotheses are needed to calculate Bergson-Stensland or Black and Scholes. And whether you, in any case, Bergson-Stensland is actually building in that compensation for dividends, slightly better than Black and Scholes, but very similar. And for those who are on the academic side or a little bit finicky about pricing and modeling, Black and Scholes or Bergson-Stensland work really better on continuous dividends. And of course, FX options, the dividends is the interest rate you get in the currency pair. So it's like it's been devised for FX options. So any other underlying, it will not work as well. Unless you work out an equivalent of a dividend over continuous dividend. Ideally, if a stock would give you a dividend 4 times a year, it would be better than once or twice a year. So the more continuous it is, the better it is. And the way you actually assume a continuous dividend is exactly the same way. You basically discount the dividend by the same factor. So something that is important is to, as I will from put and calculate easily. This is the same equation again, and because the forward is the exponential of RT times S, you can then put S equal exponential of minus RT times F. So basically, and again here we do not make any assumption on T or R. If R is next to 0 and the time to expiration is also negligible, we can go back to what I said before, C minus P equals S minus X. So this one is a strict formula. So the point is to calculate F so that you can actually then figure out whether the call pricing and or the put pricing is correct. And to do that, you basically, what people generally do, either on Excel or, if you use TOS and you have access to their the feed in Excel, generally people use a few data points, and generally where trading is liquid, so not far from ATM, you use a few prices, one call, one put, 3 times, maybe at 10, 20, 30 points, or at certain deltas away from the money. And then you have that the difference can be calculated. Of course, you have the strike, and you can actually, using this formula, you can actually determine F. So the F is the synthetic forward for the expiry you're using. So it's actually quite interesting. Again, a lot of people try and make it simpler by just using the underlying here, but this is more correct. And it's actually not a train smash. It's actually quite easy to take just a few data points to be able to determine F here. Another thing is that once you have F, you can go back to this equation, S being the underlying, and you can actually figure out what is the actual interest rate used in the formula, in Black-Scholes, or even with in the put call parity, for that matter. The thing is that we are supposed to use in Black-Scholes, we're supposed to use a risk-free rate, and many people use a proxy, so T-bills or LIBOR or anything, but you have, for example, the overnight rate, 1 week rate, 1 month rate, 2 months, 3 months. What if you don't get the correct interest rate for the correct number of days ahead? Of course, you can plot a curve and use forward rates. It can be done, but another possibility is only using the information you have on your options chain and figuring out what is the actual interest rate the market makers are using. Because market makers, okay, there can be slight anomalies, usually very temporary, but this formula is rock solid. Otherwise, it would be arbitrage opportunities, and arbitraging an option chain is virtually impossible. I know that the options market doesn't have the same type of liquidity as futures, but because of the friction cost, the mid or the bid ask being generally not very narrow, any visible or apparently visible arbitrage is actually impossible. So really, this is not complicated, and that's something I invite you to try out, because a synthetic forward is actually very it goes beyond just what I've just said about arbitrage opportunities. It's actually very useful, because once you have a synthetic forward on your Excel spreadsheet or your program, there's another benefit of it, is that you can actually get rid of the dividend effect altogether. So this is actually very interesting, because basically you can actually derive from the synthetic forward what would be the value of the underlying if there was no dividend. When people, like a lot of us, trade the Russell or SPX, those indices do not distribute dividends, but the effect of dividends has to be priced in. So it's a little bit of an odd situation. So the best way to not be bothered is actually to calculate synthetic forward, and from there calculate a something that is sometimes called UDIV, or U for underlying dividend free. I got that inspiration thanks to Gary, who pointed me to a white paper written by a very smart guy called Steve Spear. I mean, it's most market makers, most professional traders know that, but again, for some reason, it does not appear on any retail platform. And it is something that is very, very easy to do on an Excel spreadsheet. So let's have a look now at, now that we've calculated the forward price, let's have a look at ATM relationships, but to be exact, I will call them ATM forward relationship, or ATMF. So basically, it's not exactly the ATM as given by the underlying, but the ATM given by the forward price. Really, if you trade 1 month away, 6 weeks away, but are going to assume that them points apart. The forward is about 2 points, again, for expiries that are not too far away. So I could understand that we use ATM, but just to be on the strict side, I will consider these as ATMF relationships. So this comes from Black & Scholes. So now we're now back into Black & Scholes. I was a bit too lazy to rewrite all those equations, so I found those. But in that book, they use K for strike, and other books use X, so it's exactly the same. So basically, and I will come back to those ND. By the way, if any of you wants to play around with Black & Scholes, I have a spreadsheet with all the code. It's VBA, it's easy to read, it's not protected. So if anyone wants to play around with Black & Scholes, this will probably make more sense. And I think I will be short of time to give you it's going to be for next time, some interpretation of what is called the ND1, which is the cumulative density function. So, but we don't actually need to know what it does. But basically, you get the probability of touch from those components here. So all those things, you have a formula. So either you know all the math, and then great. I mean, you understand everything, the geometric Brownian motion. But we are practitioners. So if we in this group, we're just scratching the surface, and we try and get the best of the formulas and the way they are coded in a simple language. But it's more than just calculating a price. I mean, inside those formulas, there are some other interesting things to look at. So here I play a bit with the equation. I mean, it's the price of a call is this, S minus ND1 minus times ND1 minus K being the strike ND2. At the money, K is equal to S, so it makes the simplification. So basically, we have this, and if I carry on the next slide, we see that C is equal to 2 times S times delta minus 0.5, as calculated here. This is the delta. So what it shows that at the money forward, delta is always slightly higher than 50%. And again, we generally accept, we say that at the money, the delta of a call, and the same for a put, should be 50% or 0.5. Yeah, that's true. And again, to be a little bit more precise, we can figure out that the delta, just let's say a few points above the underlying, should be slightly above 50%. So if on your option chain on IB, TOS, or wherever you see that the delta is slightly higher, that's actually quite normal, because it's actually, as you see, there's no approximate. These are straight equal signs, so this is exactly what it is. So there's a direct relationship between call price and delta here. And something that is maybe more of interest, and that's why when I talked on Tuesday about simple back-of-the-envelope equations, what you can actually derive from those calculations is that the call to underlying ratio is more or less 40% of sigma, which is the implied volatility, times the square root of time. So, and vice versa, if you want to figure out what is the ATM, or more precisely ATMF volatility, this is a very, very simple formula. 2.5 times C over S multiplied by 1 over square root of T. When you start delving into analysis of the option chain, in particular the skew, and for example, I can go back to what I showed last time. A lot of modeling in the skew, or the way volatility behaves across the option chain, consists in figuring out a reference point, which will be the ATM-IV or ATM-FIV, and then the slope. Because generally when you trade, unless you trade weeklies, but when you trade monthlies, again, 1, 2, maybe up to 3 months away, the shape of the skew is fairly straight, almost linear. So by having basically a point and a slope, you can actually price basically the option chains almost entirely. I can understand that this could be above a lot of heads, but again, what I'm trying to say is that there are a lot of things we can derive from Black-Scholes, from the put call parity, just by playing around the equations a bit. And if you want to actually calculate the implied volatility without using this kind of back of the envelope equation, it's actually a lot more complicated, because as you know, Black-Scholes is a closed equation, and what is the most important thing in Black-Scholes, so basically in pricing, is volatility. Something I keep on repeating is that we are volatility traders, and we use delta because you learn a strategy, or your mentor coach tells you that, well, we're going to use delta-based adjustments. Excuse me. Yes, but it is generally a way to deal with volatility. Even if we use tools and benchmarks, yardsticks, whatever, Greeks, to manage our trade, we are basically managing volatility. I mean, a lot of us are VEGA negative traders, very, very mentioning the possibility when vol spikes strongly, how it can actually make your T+0 sink. So those things we will get into. At this time, I just want to make everyone aware and cognizant of the importance of dealing with volatility properly. That's all I wanted to say, because I want to have discussions, so I will next time bring about more easy, fairly easy relationships. I will start introducing more about volatility, not necessarily only implied volatility, but also historical volatility, and how both have some information to look at. And then when we are better equipped, I will go back into skew and volt surface. So that's it for now. And now because I still, again, this is not a training course, so I would very much, if you have questions that we, so even if you have questions that are not 100% related to what I've just said, we can discuss anything. Have I lost you all? Yeah? Only Ron's got the mic on. So any questions? I understand that it's a little bit difficult, it's a little bit theoretical, but it's just a small effort. It's not that complicated. It's not that complicated, and again, you will. I'm not saying that you have to follow my footsteps, but you know, when you understand better how prices come around, you know, and how, for example, different combos behave in different volatility environments. For example, I give you an example. The volatility, short-term volatility, is really dropping. I think SPX is near all-time highs. This is the Russell. Let's have a look at my SPX trades. Actually, yeah, I see 30-20. It keeps going up. For example, to my students today, I said, well, it's time to scale in. It's time to scale in. And again, people who know me know that I trade the Rhino, and again, I didn't design that strategy. That strategy I took over from Brian Larson, and of course, it's all part of marketing. When you want to make your strategy popular, you tend to oversimplify things. Well, it's a simple delta-based strategy, few adjustments, and you'll be fine. Well, every strategy is risk control, volatility control. So, and particularly in 2017, when the vol crashed to all-time lows, I think VIX went to 9 or something. I realized that, okay, I was still taking over, and I wouldn't say repeating, because I started changing the strategy to a changing environment. And then I realized that when volatility is low, and it may be counterintuitive, but you should narrow the wing sizes. If you, like on the Rhino, I tend to trade a 100/75 wide broken butterfly. But when volatility gets very low, you may think that by narrowing your broken butterfly, you will cover less ground. But at the same time, if the market then reverses sharply, you will be hit a lot less. So these are the things that you only realize when you analyze. If you scratch the surface a bit and you analyze what your combos, how your combos behave in different environments. Do you think that this works when DTEs are very near 2-3 days? I'm working hard on my own platform at the moment, and volatility goes all over the show when you get close to expiry. This is really, really I mean, even if I go back to what I just showed you, I mean, look, no, this is my code. Look at this formula. One over square root of t. So basically, close to maturity, your ATM volatility goes through the roof. And you have also the skew sharpening. I mean, actually, it would be good to, I'm testing it on my demo account. So this is a demo account. Let's often look at volatility. Now I've canceled September, but let's have a look at the volatility in September. It's going to be a very, very sharp. And volatility is dropping. So I don't know why it's not showing. September should still be there. Basically, it's no longer retraded. There's not much left on September. Yeah, I think most people have rolled over. There's nothing happening. But generally, when you, let's look at October. Yeah. So volatility at the money is very close to the money. Volatility will shoot up, and this curve will be very, very. I mean, I was talking earlier about the slope. So basically, when you model, you try and have a reference point and a slope. The slope will definitely get, or the gradient will get much higher near the money. The problem is not so much modeling. Well, it is complicated, but it's something that you can figure out. But because it's a closed equation, and you need volatility to get price, or price gets you volatility. It really behaves very weirdly sometimes. And one of the reasons also is that when you use your prices to figure out where your volatility is going, the problem is that near the money, 2-3 days, if you have out of the money options, they better be far away, because you can still be hit. I remember, maybe I should name him, but yeah, anyway, it doesn't matter. I remember a well-known mentor who got hit very, very badly by thinking that he was safe, and he was about 2 SD away. So be very careful if you bring your combo to expiration. But also the behavior can be very, very strange, and you may be completely out of liquidity. Even more so ITM. You are, for example, short an ITM put and you want to get rid of it. Well, you can still ask the market makers to roll over. Actually, today's Thursday, you can roll over a position right up to the open tomorrow. But you're going to be hit by the rollover price the market makers are going to give you, because pricing for is very short dated, less than a day. Basically, you have to take what the market makers give you. There's no mid. It's like a over the counter kind of thing. So be very, very careful. So I do trade weeklies, but for example, the Russell weekly position I showed you, I enter 40 DT and I close 7 DT. Sometimes next Monday 4 DT, but I never get. Excuse me. Tend to cough when I speak too much. Be careful. Be careful. I mean, once you get into modeling, you will realize that there are lots of issues, especially liquidity. What is my email? Getting a copy of Black and Scholes? Yeah, I can put it on the forum, or you can. Well, you can actually use the one Tom's given me, which is I think Bruno@ERRATUM.com. Yeah, I'm getting famous. All right. What are the other questions? There's a private from Thomas, but I don't know exactly what you mean. Okay. Are there any other questions? Because I would like maybe you to do a bit of the talking if it's not a problem. Otherwise, I'm going to cough more and more. The spreadsheet I have includes a Newton-Raphson algorithm, which is basically, I would say, a standard root finding algorithm using recursivity or recursion because this is a closed equation. So you have Black and Scholes, you have your price of a call or a put, and you want to figure out what volatility is. Being a closed equation, you have to actually use a loop to find what implied volatility gives you the price that you have from the market. And the spreadsheet also includes that. The spreadsheet also includes something called a web query. The web query actually goes onto the internet to figure out what interest rate to use and even the dividend that would be applicable. So it's a simple one, but it's actually a fairly accurate pricing I use, and it's actually the basis of my calculations in my own program. And now that you've got the tools, I would suggest that you go through what I've just said, because you have sufficient material now to calculate what I've mentioned earlier, called the UDIV, which will be a substitute for the underlying to be able to ignore dividends altogether. Because don't forget that we use an assumption of continuously distributed dividends in our equations, and they're not. So we try and massage the formula, but by using what I've just said, you calculate the UDIV, you punch in the UDIV instead of the actual underlying, and you have perfect pricing. So this is, I will get back to that, but that could be an exercise for next time. It's actually very, very interesting. You save yourself a problem. Yeah. A quick question are these topics really far above your head, or you understand where I'm getting at?
Bueno, pues mira, ha sido un partido muy...
Say it again. I couldn't hear you. Oh, it needs some time to digest. Yes, of course. Yeah. I'm trying to make it as simple as possible. Basically, if you get a little bit curious, there will be so much. For example, probability of touch. I mean, I know some people who trade. They don't even use the Greeks. They trade PCS. They don't want to think too much, and they just try and figure out whether the probability of being hit, basically. And they use whatever formula, or they use what the IV gives you for 1 SD, 2 SD, and then volatility changes. And so by actually getting a little bit more out of the Black and Scholes equation, you will get more accurate estimates for the probability of touch. Then you can, well, yeah, I will get back into that, probability of touch and probability of ending in the money. So those things I will, that deserves a full topic. But all I'm saying is that, by exploring little by little, you will get a lot more out of the material you're using. Greeks for trading, yes. Right, yeah, I can do that. I wouldn't want to show stuff that is specifically aimed at my own trading style. So if there's anything you would like me to look at, for example, RTT or Rhino or another type of trade, I can analyze it in the light of what I've been showing you, how to get more out of your platform and maybe get a better understanding of the risk you're taking. Again, any strategy has got its strengths and weaknesses. When I was struggling a little bit with the Rhino in low IV environments, the RTT did better. And then when the environment changes, it's better to get back to another strategy. And switching strategies or massaging a strategy because you understand better how the Greeks behave. For example, the delta of a VEGA ratio. Those things are very important. Actually, my Rhino has now included an RTT mutation. I actually figured out that, yeah, I mean, why keeping on fighting a volatility crash at the money and above the money, which makes my delta go very, very sharp, i.e. my trade was losing fast on the grinding market. So by understanding what a combo does, like RTT versus a Rhino or a Kevlar or an M3, you then realize that maybe it's time to switch. But I don't want to make it more complicated because I know, for example, for people who trade John Locke's X4, there are dozens of variants. So I'm trying more or less to say the same, but I would like you to understand why you would switch from one type of adjustment to another type of adjustment. So we can definitely maybe give me another 1 or 2 sessions to cover all the basics, and then it will be quite interesting to analyze trades and why this trade is doing better than another. But yeah, sounds good if Greeks can give me some warnings of a trade in risk. Yes, yeah. Actually, can't remember whether it was on the trading group or this particular group, I started introducing a second order Greek called VEGA. And I wish I had my own platform at the time, because VEGA is a second degree derivative to IV. So basically it's the first order derivative of VEGA. So, and unfortunately, no platform does that. I have coded it for my own. So what does it do? Well, it tells you that if VEGA is very strong, the chance of your VEGA going sky high and your T+0 sinking abruptly is getting high. And for example, early 2018, VEGA, and nobody was looking at VEGA. You were in a low IV environment. So if your trades were very far out of the money, there was a chance that your VEGA would be small, so you would be less affected. But if you were near the money, VEGA kicking back, and even more strongly, because you have VEGA fueling a lot more VEGA. So yes, I will cover more Greeks and how they affect your trading. Yeah, but again, this is not a trading course. I'm just giving you bits and pieces for you to digest. But if you stick around, yeah, you will be better equipped to basically go beyond a trading strategy. I assume that some of you follow the RTT, or you're not part of my group, so otherwise I would recognize your names. But anything, maybe other, like M3 or whatever. And you want to figure out, understand why this strategy is not working. I've done my back tests, and what's going wrong? Yes, but the market is not the same. I mean, when the market was actually teasing all-time highs 2 years ago, volatility was quite low. Volatility, now we're back at all-time highs. We may be even going beyond. I don't know exactly where we are now. Yeah, it looks like the 30-20 is holding. What I'm saying is that we're definitely not in similar environment. We have a lot more room to maneuver a trade because we have more volatility to play with. That's why these trades are doing absolutely fine. If you look at, so I'm not here to advertise for my trades, but look, I've got a fantastic downside cover. My upper expression line is over 3%. I'm very, very cool. So, I mean, I've been trading for many years, but up to 2013, 2014, I was basically rehashing what I had learned. And it's only later that I got into analyzing a bit more. And of course, even if I was better equipped, I still got hit last year, like many people, because of VEGA that I didn't have. But I think now if you have better tools and better understanding, you will be in a better position to be more independent, basically, more autonomous, because you will not rely on someone telling you what to do. And sometimes it's hard just to replicate something that's being given and you don't understand why, because it's something in the mentor's head. So basically, yeah, you will feel a lot more confident. I know that some people build their own self-confidence through backtesting. I've got my own grudges and or doubts about the interest of backtesting, but yeah, but I think knowledge is better. That's why I ended my little presentation. It's going to be the motto going forward. In the meantime, keep thinking. That's all I want to say. Okay, this is the end of the hour. I didn't want to speak for the full hour, but like last time, I ended up doing so. So any final questions? Oh, you're welcome, and please come back next time. I will post the presentation, the PowerPoint, on the forum, and I think, oh, you know what? Yes, I'm going to, if I post the spreadsheet on the forum, I will, the number of downloads will not be shown. So better if you ask me and I will send it. So you have my email address, and I will send you to your private email. Okay, thanks for coming, and I hope to see you in 2 weeks' time. Bye for now.